and I'm just delighted to anchor our Berkshire Hathaway panel with these very distinguished experts here. It is a staple of the ETF that I run, the Berkshire Holdings, so this is always very good session for me, just an insight as well. Again, the content will be recorded, reproduced on the site, so if you miss some things, you'll be able to catch up otherwise. Okay, so to start off, my three panelists, Todd Finkle is behind me, and Todd, just produced this book, which he will be signing at the Bookworm. It just goes into his Warren Buffett, his early career. He's a professor at Gonzaga. And then Chris Bloomstran, who I'm sure you all know, is a portfolio manager at Semper Augustus, well-known expert, has written quite a bit about Berkshire Hathaway. And then Adam Mead on the end, who's written this book, which we talked about last year, a very comprehensive book, which I think everybody should get, the Encyclopedia of Berkshire Hathaway, and some great insights there. So I don't want to spend any more time on the intros. Let's get right into the Q&A. And please welcome our panelists. Good morning, guys.
Morning.
Okay, so a couple of weeks ago, Buffett did an interview with Greg Abel, which we know is all about the succession planning. And I think at this point we have a pretty good sense of who the leadership structure is going to be after he leaves. But we got a little glimpse into how he feels about Greg and his leadership style and his interaction with the different affiliates or subsidiaries. So maybe we could just start with Adam. Let's talk about kind of this transition that will happen over the next decade. What will it mean for the organization to have Greg running the show, and what will that mean, performance, interaction, et cetera, and also for the kind of the temperature of this weekend and how they interact with investors?
Sure. Well, I think to begin with, the good thing is it's already started. It started in 2018 when Greg and Ajit were named vice chairman of non-insurance and insurance respectively. And so having that transition period up until a couple of years ago when Charlie slipped and kind of made it known that he was heir apparent. So to have this transition happen under Warren's leadership, I think first of all is just fantastic. And as Warren said in that interview, Ajit is not competing for the job, so we don't have that sort of same dynamic that might have played out at another organization. But I've spoken to some of the managers over the years, across the street during the meeting, and they enjoy reporting to Greg, and I think that same dynamic of the autonomy, but also having that receptive audience when they need it is still there. And so, one manager said, he'll check in maybe every couple of months, or if I need something, I can call him. He'll call me back right away. So I think it's been a good transition, and I wouldn't expect much different going forward. Kind of the same playbook. This Socratic method that he mentioned in the interview of just kind of going at it new and really just getting to learn these businesses has been a good thing for the managers and for Greg as well.
I think Warren recognized that he needed to slow down the job of overseeing all of these non-insurance subs is a Herculean task. We put Greg on the job. He's the direct report of everybody. The word I get from everybody I know in the Berkshire world is Greg is absolutely fantastic. I mean, he's not going to cover off the ball. He really understands business. He understands capital allocation. Little things like if you were the CEO of a business and you sold the business to Omaha, you're going to send your capital to Omaha. You would be deferential. I mean, who am I to reinvest capital when Omaha's done it so well for so many years? Nothing but great feedback. I think you can see it in the results. If you know my letter, I've put together the whole MSR group back to 2003 when it was first broken out in the annual report. It went missing, and I've tried to reconstruct where kind of the equity capital is in each sub. And you can see from 03 forward, businesses that weren't reinvesting themselves, returns on equity of the group of manufacturing service retail companies, now finance, had declined from a 10 unlevered ROE down to a 6 or so, which is fairly unacceptable. And pretty much at the moment that Greg came in and they recognized a write-down on Precision, you've seen an incremental growth, and you've now got the ROE of that group back up to 10. And I think that's a testament to Greg's hands-on approach and subs looking for reinvestment opportunity. I think in places where you've replaced a CEO with another CEO, they've tweaked some compensation structures. So, and Greg gets it, and I hope he gets a very long run because I think he's that good.
Buffett's probably dreamed about this a million times, about who's going to run his company after he's gone. This is his baby, and he always talks about drawing the masterpiece. This is probably the last piece, in his life that's going to go in there. He's not going to screw this up. And I don't know, Greg, but the only concern that I would have from an entrepreneurial perspective, because I teach that at the university level, is how would he, Greg, compare to Warren's incredible entrepreneurial drive and vision? Does he have that capacity? I don't know. Chris probably knows more than I do. He's quite the expert on Berkshire and Adam, but that's what I would be looking for, in the future. How will he be able to? Can he do a Japanese deal like Warren just did? That's just genius to me. So that's about all I have to say.
Well, certainly tough footsteps to follow in for sure, but we'll get some more, I think, from Greg, as he comes to the ladder. It does seem like this interview a few weeks ago was kind of another introduction to his leadership and being more pronounced kind of as the forefront of the organization. All right, maybe shifting gears a little bit, we'll go to Chris on this, insurance, and obviously Berkshire's well known for it. They've had some nice things happen, I think, over the last year. They've incorporated Allegheny last quarter, or in the fourth quarter, and they've also brought on Joe Brandon in the leadership group there. So that's been a positive. Certainly the higher rates are going to help going forward, as we know, but there's been some challenges at Geico. So, when you put it all together, some puts and takes, still a very strong business. Maybe you could just get us up to speed on what's going on today and sort of the outlook in the interim.
Yeah, Berkshire is still an insurance operation. After the National Indemnity purchase in 1967, this thing really was fully insurance. And the way it was operated with the conservatism of underwriting allowed the business to build up an enormous amount of surplus capital that allowed for the acquisition of Mid-American in 2010, or 2000, right after the 03, I guess, the acquisition of the railroad in 2010. National Indemnity, for those that think the 92-year-old that runs this place has lost his touch, this was an absolute home run for Berkshire. Allegheny, like so many businesses inside of Berkshire, are better businesses for being a part of the conglomerate. Allegheny, run by Weston Hicks for about 20 years, Joe Brandon, more recently. Weston retired at the end of 21. It's basically an insurance operation. They've got three businesses: TransRe, which writes reinsurance, $5 billion in premium, and a couple specialty businesses, Cap Specialty and RSUI. Paid $11.5 billion for a business that had $9 billion in equity capital. You think about how insurance runs inside of Berkshire with surplus capital, you don't have to go to the reinsurance market. So most of what these three insurance subs writes will be retained. The real advantage is because Berkshire has surplus capital, they can have a larger stock portfolio proportionally to the investment portfolio. So where Allegheny had $3.5 billion out of what was $22 billion, $20 billion by the time the deal closed because bond prices declined last year, Berkshire can run that portfolio at 17 or 18 billion in stocks and not 3.5. That's worth $600 or $700 million. Nuance to this deal, and we all know Markel Ventures and Fairfax's private businesses. Well, Allegheny had Allegheny Capital. When that deal closed, Weston had been buying private businesses, had a couple brokers that were sourcing deals, paying commissions, and those commissions were kind of masking the profitability of these businesses. So at year-end 21, when that deal closed, you had about $1.2 billion in equity capital out of the 9 that Allegheny had, and the thing was earning 12. So all those commissions were running off. My understanding is in that following year, the deal closed in October, The one, call it 1.3 billion, earned 30% pre-tax ROE. Call it a 24% pre-tax. The profitability of that group doubled. And I could get to, on the numbers there, maybe $5 billion of value for those private businesses, W&W Steel and Kentucky Trailer and Jazzwares and all of those. So essentially you put it all together and all the advantages Berkshire has, I mean, they essentially paid about 5 times earnings, 20% earnings yield for Allegheny. In reinsurance, Berkshire, the reinsurance group has been very profitable in the last few years. They've been getting price for 3 years in a row. What happened last year in the reinsurance world with the crushing of bond portfolios, the inflation we have in the system, global reinsurance capital worldwide a year ago was about $675 billion. Declined to $550 billion. You'd lost an enormous amount of capital, some between losses for hurricanes, but that was mostly declines in asset prices. Berkshire's entire insurance group has about $275 billion in statutory surplus, which is insurance book value. 20-ish of that goes to Geico, 20-ish of that goes to primary, which means you've got $230, $240 billion of capital, of equity capital, just for the reinsurance operation. There you've got maybe $350 billion of premiums written globally. Berkshire's going to write 26 or 27 billion. So Berkshire writes 7% of the global reinsurance premium, but they've got almost half of reinsurance capital. It's staggering. And for that, they can have a $350 billion stock portfolio, only $100 billion in bonds and cash. Just enormous advantage. They're getting price. When that insurance capital shrinks, other writers can't write as much business. You can only write so much business for the amount of capital you have. So Berkshire's going to write a bunch more business. You heard Warren say in the interview when he was in Japan, they're writing more cat business. They haven't written a lot of cat because of the hurricanes and so much competition. Pricing was terrible. Berkshire can walk away from business. And then a quick comment on Geico. Geico has been lagging Progressive pretty badly for the last handful of years. We all know Todd's running it. Whether that makes sense or not long term, I don't know. Most auto insurers have struggled in the last couple of years for the inflation we have. The cost of fixing cars is very expensive. We have part shortages. You've got labor shortages. Cars are in the shop longer, which means you've got to pay for more rental cars. The Manheim index of used car prices got really high last year. It came back down, but now it's back up. Progressive just reported, and Progressive is going to cut advertising spending this year. And they're getting price. Everybody's getting price. So when you're losing money, when the industry is losing a bunch of money because there's inflation in the system, you go to the state insurance commissioners and raise price. Berkshire took price last year. They didn't take it in 21. Progressive took it in 21. Last year, Berkshire cut advertising spending by 15%. Now, Berkshire doesn't have agents and brokers. So all of the growth that you get in policies comes from, there's a direct correlation of what you're spending on advertising. They cut advertising. Progressive is going to cut advertising this year. So it'll be very interesting to see how it plays out. Berkshire lost policies. They lost about 9% of their policies in force last year. Geico did. We'll see what we do. It's going to be really interesting to see what they did in the first quarter with the advertising spend, which we're going to find out in tomorrow's Q. But I don't think it's as bad because price fixes a lot of problems. I mean, Geico is clearly still behind in things like telematics, but they're going to get share this year, and they're getting a lot of price. I mean, states like, and I think the reason they cut last year, this is important, is states on the left and the right coast, California, New Jersey, New York, brutal states for underwriting auto insurance. If you're not going to get price, why would you write business in the state? So I think selectively, they've probably targeted where they can cut advertising spending in the places where they just didn't want business. I think what they've done in reinsurance, they did in the auto business last year, and they walked away from business in places where they weren't getting enough price. Well, now you're finally getting a bunch of price in California. You're getting price in New Jersey. So my guess is you got pretty much even on market share with Progressive. My guess would be, Geico may surge back ahead on the auto book this year. So it'll be a fascinating year in auto, but they're going to make money, I believe, in auto. Stay tuned.
Well, that's pretty exciting. Adam, why don't you talk about another, perhaps a company or theme that's going on for Berkshire right now, and discuss why you think is relevant to bring it up to our audience.
Okay. I think one of the most obvious underappreciated assets that Berkshire has is Berkshire Hathaway Energy, actually. It's kind of this, it's a boring utility business, right, on its front. Most utility businesses, many utility businesses, pay out most of their earnings as dividends. Well, if Berkshire Hathaway Energy had a motto, it would probably read, milk me later. That business, since Berkshire acquired it in March of 2000, I think it was March 14th, they paid $35.05 per share. With, I guess Warren has joked that the extra 5 cents was they got the last nickel out of them. But last year when Gabelli sold his shares to Berkshire Hathaway, the parent company, he was paid $1,174 for his shares. Now that included a BYD and probably some extra cash on the books, but you have this incredible steady compounding asset. Now, to be fair, there were a couple times over that 22-year ownership history when they purchased NV Energy, when they purchased AltaLink, I think Berkshire made an additional capital investment into the energy business. But by and large, that has come about from steady, regulated, in some cases unregulated returns. And just that steady compounding over time, I mean, the energy business is probably, well, it's certainly in the top 2 or 3, but that business, I think, over the next decade, certainly is going to become really a powerhouse. And you've seen, tomorrow we're going to see a couple of shareholder proposals on ESG, and we've seen that for a couple of years. Well, this business, they're already ahead of the curve on a lot of those fronts. I think that business, 45% of their assets are non-carbon sources. You have this tremendous runway of reinvestment opportunity. So reinvestment, not only the earnings, but then layer on some debt and an appropriate leverage ratio. And then, I think as Chris mentioned, if they need additional capital, it's there. And so you have this business where it's probably earning about $3.9 billion after tax. If you want to throw in probably about another $900 million a year for cash tax savings. So this heavy reinvestment creates pretty significant deferred tax liability. So that cash tax earnings, those cash earnings have really, I mean, they've continued to go up. A little bit of a dip with the tax change in 2017, but you have this incredible asset, and then on top of that, being within Berkshire Hathaway, last year the tax line was a negative $1.6 billion. So any other utility could not take advantage of these tax opportunities that Berkshire Hathaway Energy has in wind and solar and so forth, right across the river here in Iowa particularly. So just in terms of the steady compounding and, again, under Greg Abel's leadership and the folks there, I think that business is going to become much more appreciated over time, especially as we get into more renewables in the western United States and the transmission assets that they're building there, which have 5, 10, sometimes 15-year time cycles to get those assets in place. They're doing the work day by day, and it'll become an even bigger part of Berkshire Hathaway going forward.
Todd, and
so ESG. This guy's laughing at me. It just seems like every time I go and talk about Warren Buffett somewhere, somebody hammers me with a question on ESG. Some guy just kind of was going nuts on me after I talked about ESG. I don't even really mention ESG in my book, and this guy's going after me after my talk, and then a guy from Belgium, a journalist from Belgium yesterday wants to talk to me about ESG and Warren Buffett, and I just want to open it up to everybody up here on your thoughts about ESG. I know Chris has talked about it before.
Well-intentioned, but it's really stupid. It's just misapplied. You've got all these proxy proposals on climate, separating the role of the chairman and CEO, which I generally endorse, I think we all would. But at Berkshire Hathaway, you've got the guy that's run it since 1965, has voting control of the business, still sharp, he's running capital allocation, spent $75 billion last year. The proposal comes from a little not-for-profit that has $2 million in revenues, they spend it all, they've got $1 million in assets. The guy pays himself a salary of $260,000, over 25% of their invested assets. And as far as I can tell, he's the chairman and the CEO of the little thing. The climate stuff, to Adam's point, I mean, Berkshire's, if the railroad and the utility have public debt, so they file their own Qs and their own Ks, their climate disclosures are robust. They've closed 16 coal plants, they're gonna close another 16, they're gonna close the final 10. They signed the Paris Climate Accord. They're far ahead of most electric utilities in the country on the conversion to renewables intelligently. They understand tax policy, and they probably wouldn't make these investments in very inefficient sources of power, but they're getting paid to do it. You've got a negative almost 50% tax rate, but the CalPERS of the world and the Quebec pension systems probably ought to stick to their own knitting and not instruct a Berkshire Hathaway that does more really on the governance standpoint. The chairman and vice chairman pay themselves $100,000 salaries. Nobody in the place has ever been paid a stock option or a restricted share grant. Greg just bought over $100 million worth of Berkshire out of his own pocket. Ajit owns over $200 million. Find another public company in the world where the insiders have reached into their own pockets and purchased substantial positions in those companies. I mean, I hope the way the governance is run at this place, the place across the street tomorrow, persists for another 20, 30, 40 years, because of all the public companies that you can follow, they do it right. They do it right, and to be criticized for it, it's just, Berkshire is a very public entity with the annual meeting is a big deal. And these activist groups use the meeting and they use the proxy as a soapbox for agendas that really have no place at Berkshire Hathaway because they are already doing it right. And to tell them to do a checkbox in climate is ridiculous.
You want anything, Adam?
No, I'll be Charlie, nothing to add.
Well, I wanted to volunteer one aspect of the company that I've looked at. We actually follow this business pretty closely. That's Kraft Heinz. And I think it's important, we follow the equities, we follow the operating businesses, and then there's the equity investments. And I think there's going to be a nice jump there this year. Obviously, we know the incorporation of Occidental will be consolidated, and Kraft Heinz, which got off to a slow start, but if you look at that contribution, that's going to move the needle or the line there. This year, they just reported very strong results. Their big asset there is ketchup, which Buffett's been a big fan of, and it's a very valuable piece, and has obviously seen good business trends just given the dining trends that we've seen in the U.S. And so that did about $2.5 billion of income last year. It's going to do close to $3.5 billion this year. Kraft Heinz, Berkshire owns about 325 million shares, 26%. So that'll be a nice contributor to the equity earnings. And I mean, that's a business that's doing very nicely within kind of a potential recessionary environment that we're going into. And certainly, doing better than when it first started being incorporated. I wanted to switch gears now, thinking about financial engineering post-Buffett. And we've heard a lot of the press, a lot of people have said, well, are they going to break up Berkshire Hathaway? Is there going to be anything that happens once he leaves? And I would just say, we would probably all agree that when we look at the business on a sum of the parts business, we still, we see more value than the current capitalization today. And that's great. That being said, we know that there's, as we talked about a little bit, the inherent benefits of the conglomerate structure, tax, capital allocation, the kind of the scale and sort of how it's uniquely valuable. But given the makeup of some of these operating companies too, being within the insurance business, I was wondering if we could just kind of go through the panelists, talk about what your expectations for potential financial engineering post-Buffett. What does it actually mean to have this structure with assets embedded in the insurance? How easily could they be extracted? And then the last thing is, would a change in financial engineering or approach to that impact their ability to do acquisitions at fair prices in the future? You want to start?
I don't think they'll break up. I think Warren wants the culture the way it is. He has Howie that's going to take over for him as chairman of the board. And more recently, he put Susie on the board of directors as well. Wally Weitz is a local guy in Omaha who's now on the board. He's putting on the players that will fulfill his dream after he's gone. My guess is that it won't break up. And I know Adam thinks that way as well, because I read it in your book. And the tax ramifications that you talk about as well, I think that that's to their benefit. But yeah, I don't really have much more to say than that.
I think there's not a lot of financial engineering to do. I mean, you think about the big levers and the big moving parts. I talked about Allegheny being a much better business inside of Berkshire. Its earning power, standalone, was about $1 billion a year. Inside of Berkshire, it's $2 billion. It's twice as valuable held inside of the insurance operation. The embedded advantages of the utilities being able to retain all of that profit and invest in growth CapEx, building out the wind, solar, the grid that goes with it, just huge structural advantages. I think there are opportunities, and you've seen some of that already in the manufacturing service group, businesses that really are no longer as profitable as they might have been when they were bought. You'll need some inertia, but Gray's getting his mind around that. I think the old adage that you sold your business permanently to Berkshire Hathaway and we'll keep it forever has generally been true. Some businesses die like the World Book, that they just go away. They've had to close them. The three biggest mistakes in Berkshire's past were the textile business itself, which they bought in 1965, diversified retailing and blue chip stamps. 3 of the first 5 biggest deals essentially all went to zero. And Berkshire and Mr. Buffett have been very good at pivoting. So I think there are places in the MSR group where those businesses are generally run unlevered, no debt, and the ones that are earning 4, 5, 6% on unlevered equity in the hands of private equity and the magic that they can do with leverage, you can goose up an ROE into the teens and spend some stuff. So I think there are places to sell some underperforming businesses where folks that like to do financial engineering can do it. And I think you'll see that more as the transition to Greg and his team and the successive managers of the operation take hold. But largely, not a lot to do. And the calls for massive breaking up of Berkshire that you see a lot in the media talk about, that just makes no sense. I mean, the advantages of having these businesses together is hugely important.
Yeah, I mean, I talked about that $1.6 billion negative tax rate for Berkshire Hathaway Energy. I mean, that largely goes away if it's not within Berkshire Hathaway. But Chris talked about the incredible capital strength that Berkshire Hathaway's insurers have, and Mac, your question gets to the behind the scenes. So Burlington Northern Santa Fe, when Berkshire Hathaway purchased that in 2010, the first owner is National Indemnity. So an entire railroad is owned by the insurance business. So I think that's what you're getting at with the being tied up, and can that happen? I think the sheer amount of capital that Berkshire has would allow that to happen if they wanted it to happen. But I think the risk of detracting from current managers and then future acquisitions is a real one that should be taken very seriously, because that reputation that Berkshire has, that Buffett continues to nurture, that's very important. And so, spinning off a little unit or, underperforming one might seem like a way to get that little extra return, but what will that do 10, 15 years down the road in terms of detracting someone that might sell their business to Berkshire Hathaway? Another advantage of having the conglomerate structure, when we talk about the ease of movement of capital around the subsidiaries, usually that's in sort of pull sense, and what I mean by that is, okay, there's an opportunity over here, let's take some cash and move it. Well, I think there's an incredible amount of value in optimizing the capital structure of a business. So you think about See's Candy. If See's Candy were forced to retain all of their earnings over time, it would have become a terrible business because they would have gotten into areas where they really couldn't generate a return. And so having this relief valve for the subsidiaries, I think is another underappreciated aspect of Berkshire Hathaway. And I think Greg alluded to the fact that Berkshire's the best bank in the world. So these managers have the opportunity to dividend up any excess capital, and if they need it, they just pick up the phone and they'll have it tomorrow. So I think this unique dynamic of maintaining that optimal capital structure, and if a business doesn't grow within Berkshire Hathaway, that doesn't mean it can't be extremely valuable, which we've seen with See's, we've seen with some of Scott Fetzer's subsidiaries over time. Just send the cash to Omaha and let the folks in Omaha, Warren and Todd and Ted, take care of that capital allocation and run the business to the best of its ability across multiple dimensions. So don't break it up.
Is there a way in which they could break up Berkshire? How would that work?
That would be a Standard Oil. The government might say you're too big, but I think you'll see special dividends and things like that before you see it broken up. There's one other point I want to make. This is my opinion, but I think the days of Berkshire getting deals because people want to see their business owned inside of a family, I think those days are long gone. There's way too much private equity capital sloshing around. That if you're going to buy a business, you're going to pay a control premium, and you may not be in a bidding war, but you're not going to get bargains. But then you go to a public company like an Allegheny and buy the thing, and Warren negotiated a heck of a deal there. But the private businesses, the smaller businesses that are going to get bolted on inside the MSR group, I'm not sure. I think that's a quaint notion that that thing that existed 20 and 30 years ago will persist. I think those days are long gone.
You don't think there's value in that autonomy and not having to report to a investor group over time? Maybe you think incrementally we'll see.
The culture of the place is great, but I don't think there are many people going to sell their business for a big discount anymore.
Oh, sure.
Okay, so tomorrow, once again, we have the AGM, and I'm sure there'll be some surprises, and we'll all look to it in terms of some of the feedback. Maybe starting with Todd again, just going down the row. What are your expectations for what we may hear tomorrow? What are the maybe rank the topics of importance that you think might come up?
So I think the Berkshire meeting, this will be my 13th one, and I classify it as a carnival, a rock concert, and a cult. All three, and I'm, of course, right in the middle of it with you guys. And it's a lot of fun. I've taken lots of students to go to the meeting, and they always have a blast. I look for a good movie. That's always entertaining. Charlie always gets the woman in the movie. Warren never gets the woman. Poor Warren. And I look for that to happen again. And topics, banks are huge right now. Oil, ESG, railroads, insurance. Stop me if I'm missing something. What else? Japanese investments is now his biggest position, even bigger than all of Europe combined, is in Japan. So I look for him to continue to invest in Japan. And I wish I knew more about it. That would be something that I would be really looking into if I were you guys. Exactly what's he up to in Japan? I'd like to know more. He made a lot of money when I saw him on TV the other day, he was really giddy about making all that money in Japan. And Warren isn't usually that giddy, but he was that day. I'll let Chris go next.
Oh, it's just a celebration. I've come to the meeting since 2000 when we bought the stock for the first time. Missed one meeting. My daughter, my oldest, was born on February 18 of 01, so the meeting was 2 weeks inside, so I didn't get the pass to come. She's graduating from college next weekend, if you can believe it. All these years have passed. The fact that we still get this, what we're going to have tomorrow with 92 and a 99-year-old as sharp as they are, whether Warren answers 3 questions in the morning session or 1, or he gets to 20, doesn't matter. He'll still cover a lot of ground, and just take each of these years that we still get as a victory, because it's been one of the greatest pleasures to be here in Omaha every year and listen to these guys answer questions for 6.5 hours, and the time we all get to spend with each other makes this meeting a special place. So I simply hope when they're gone that we still all do this, and we come to Omaha and we gather and celebrate. It'll be an entirely different meeting, formal meeting itself, but I hope this community that we all have persists.
Well, yeah. You're here. I've been coming since 2012, and so I hope to continue coming when I'm Charlie's age, which will be into the 2080s. So I hope to see it that long. Just the friendships, lifelong friendships from folks all around the world. It's just incredible. And you think about just the compounding of goodwill and the friendships and everything. That's going to continue. I'm confident that will continue decades into the future. But Mac, tomorrow, I think interest rates are probably, he's going to get a number of questions on interest rates. I'd like to see Greg get some more face time and maybe some real depth there with Greg and Ajit, and really kind of delve into some of the specifics of maybe his day-to-day, or just some more meat on the bones from that Tokyo interview. I think that was just a fantastic interview, and we learned a lot about Greg and how Warren thinks. Be interested to see if Warren has any comments on Activision. That they own a big chunk of Activision, and the UK regulatory decision to knock that down, at least in the UK, whether that changes the calculus for Activision. I suspect it won't, but he may get a question on that. I think there's a lot of fruit this year, and I'm with Chris. I think you just sit back. And just listen to those guys all day long. Last year, Warren has sort of apologized for only getting in so many questions last year. Well, I think those are the special moments. You get to past years, sort of the end of the meeting, and they kind of start bantering back and forth on each other. And we heard, this story about Warren and Charlie sort of strong-arming the investment bank for a lower fee. All these little nuggets. I would love to have them spend some time on the past and kind of just, give us some of those nuggets that, we'll appreciate.
We're almost out of time. I did want to, we were going to discuss our price targets and our valuation, but we're going to have to keep that a secret. But I wanted to address the idea that in a post-Buffett world, what happens to the stock? I think I've heard a lot of questions recently, the day that something changes, what is the reaction to the stock, and then does it impact the long term? And I think you've
I
done
did some
work
research on that. I looked at Steve Jobs and what happened to him after he got sick, and then after he died. And after he got sick, Steve Cook took over. The stock price went down like 7-8%, but then it went back up by the end of the year. And that continued to happen because Jobs got sick a lot and he took a leave of absence. And Cook did a great job of taking over. I also looked at Microsoft, Gates, Ballmer, Ballmer, when he was the head of Microsoft, he lost 30% from their stock price. And the S&P, I think, was up 20 or 30%. So Ballmer really, I don't need to say more. And And then, you know, Satya took over, and he's been great. You know, he's been awesome. So the point I guess I'm trying to make is, you know, you never know who's in there.
I think avoiding the price target's good. Warren, I think, has even said he thought the stock might go up on the day he died. I've been asked that question. More of any Berkshire question that I've had is, what happens when Warren Buffett dies? Oh my God. And the folks that have been waiting for 20 and 30 and 40 years to buy it on that day have missed a heck of a run. If the stock drops, that's wonderful because we've always got cash flows, and I love to buy the stock when it's cheap. And I think to the extent Berkshire's in the mode of buying the stock back when it's cheap, they've bought 60 billion-ish of the stock in the last 4 or 5 years. Buy low, sell high, and sell your shares, drive it down because Omaha's going to buy it and we're going to buy it.
Yeah, I think, you know, I believe, I'm not 100% certain on this, but I believe that the current share repurchase authorization is if Warren and Charlie feel the shares are undervalued. So I'd like to see that made into just a blanket, you know, board authorization today, and just, I hope it goes down. I hope they're buying. You know, I'd be looking to buy it at that point. But if the value of Berkshire Hathaway is all of the future cash flows, and you know I'm going to own it for another 50 years, you know the value of Berkshire is not going to change. It's not going to go down 7-8% overnight. You know that's going to be those folks that really haven't studied the business, and I think everyone in this room who has studied the company, you know, and recognized the value, which is you know pretty clear, I think. Just hold on.
Well, great. I'm sorry we couldn't take questions, but that was a wonderful panel. On behalf of the Gabelli organization, thank you for coming today. And I'd like to turn it over to the next panel and my colleague, Brett Kearney.
Thanks, Mike.
Thank you, guys. Great stuff.